Joint Managing Director of Kotak Mahindra Bank joins us live from his Mumbai office. Mr. Jayaram, good morning. Thank you for joining us. Mr. Jayaram, what do you expect to hear from Reserve Bank of India tomorrow? Do you think they're likely to spook nerves further, or they could really do something to calm nerves?
Probably neither, I think. I think much of what they wanted to do in the context of reducing the volatility and currency, they have already done. So my expectation is that the policy would have pretty much no announcement on any increase in sort of repo rates or CRR, etc. I think what one expects more from this policy is to sense the undertone in terms of what is their probable definition of the short period which they have talked about in the context of the recent sort of measures they have introduced. So I think cues will be taken more from those sort of things rather than any specific changes in rates.
Do you think we've hit some kind of a wall? Earnings are not gangbusters, liquidity is patchy, Reserve Bank of India is threatening to spoil the recovery cycle. So do you think in the near term Indian markets are unlikely to do anything?
I'd broadly say that at this point of time there don't seem to be any immediate cues emerging from the domestic economy to sort of move rates, to move markets up, and probably not down either. So I think at least for the next few months, the cues will have to come from global factors. And my suspicion is that your market movements over the next few months will be primarily determined by what's happening globally.
Do you think globally all the fears of liquidity have been quelled? Because the US Fed clearly and explicitly has indicated that, look, we are dependent on data. The US economy has not recovered. Yes, green shoots are there, but as of now, we don't know whether these are green shoots or yellow weeds.
Well, I think what happened broadly is that when the first sort of announcement was made by Mr. Bernanke, I think markets probably overreacted and there was an immediate outflow from a lot of markets, including emerging markets. Subsequently, I think there has been more calming announcements to the fact that the whole program, the bond program would probably come off at a much slower pace than what was originally anticipated. So I think currently that seems to be the broad consensus that while it's certain that QE would have to taper off at some point of time, it's probably likely to happen at a slower pace than what was originally anticipated.
Are you buyers into banks right now? Would you be of the view that it's time to buy into private banks without getting into names? Because yes, Reserve Bank of India measures in the short term, they will have an impact on the borrowing cost. But private banks have managed to withstand a bad cycle.
A couple of things in private banks. One, they've obviously gone through a fairly good period as far as markets are concerned over the last year or so. And to that extent, you wouldn't call valuations exactly cheap for many of these private banks. Two, you're still going through a period when there are challenges in the economy, when there are sort of fears that overall sort of growth could slow down. B, there could be an increase in NPAs if that slowdown does indeed continue, etc. So I would sort of argue that the overall environment is still probably a little challenging for the entire banking sector. And to that extent, for somebody who wants to take a call on certain sectors, I'm not sure that this is the most appropriate time to make a call on banking.
Jayaram, you've recently said that FMCG names like an ITC, Unilever are unlikely to see further upside. Does the quarterly performance of these names then vindicate your stand, and is it time now to relook?
Well, performance certainly, because we're starting to see sort of consumption taper off over the last quarter or so. But even more importantly, I think again valuations there in many of these sort of stocks which you talked about are very challenging, and to that extent, somebody who wants to sort of enter at these sort of levels, I would suspect may have some reservations about entering at these valuations.
Jayaram, have you liked the earnings that we've seen from the IT majors this time?
Yes, I think by and large the IT majors, after some disappointing quarters earlier on, have started to look much better. And I think clearly the depreciation of the currency helps them in some fashion. I think the only worry there is the status and the final implementation of the new immigration bill in the US. And I think there are there's still a fair amount of uncertainty about how that will finally pan out. But if you pass that aside for a minute, the IT sector is certainly looking far better than, particularly the larger IT names, are looking far better than what they have done for a period of time.
What is fueling your optimism for IT stocks? Weak currency or business prospects?
No, I think weak currency is a sort of good environment for them to operate in. But I think the U.S. recovery itself brings certain optimism to the table as far as they are concerned. But like I said, the big sort of overhang there is the immigration bill, which is expected to sort of go through in some fashion over the next few months. And I think that could have a reasonably significant impact on the Indian IT sector.
Jayaram, the need of the hour is to fix the rupee, and our last year's deficit got funded largely because of equity inflows. Now, equity inflows have become outflows. So, irrespective of what Reserve Bank of India will do you think it's the state of the equity market which clearly will create a pressure on the rupee?
I think that's probably over-arguing the fact because I think just as important as equity flows have been, I think one of the big issues has been outflow of FII debt in the immediate short term. So I think there is a clear necessity to fix the currency at some level because as foreign investors, whether investing into equity or into debt, need, the first and most important thing that they need is to have some model around which they can build their currency sort of numbers. So you can't have a situation where the currency has been as volatile as it has been in the last month or so. So I think unless that problem is fixed in some fashion, where the foreign investor has some comfort that the rupee is in a fairly narrow range, at least for a certain period of time, it's only then that I think that you can talk about bringing back equity flows and indeed debt flows.